Good morning. Today we in accounting, go to ledger accounting and double entry bookkeeping. So when we talk about double entry is basically the duality in accounting concept, which means for every debit entry there must be a corresponding credit entry. So we start with the ledgers. For the ledgers, as soon as different accounts or journals are completed, it is important to do their postings into different ledgers. So when we talk about posting, it means we are transferring different accounts to each ledger, which can be a trade receivable ledger, trade payables ledger, or nominal ledger. So when we talk about trade receivables, for trade receivable ledger, we're talking about accounts or ledgers opened for credit customers. Trade receivables, accounts or ledgers opened for credit customers. That is trade receivables. Then we have trade payable ledgers. These are accounts opened for credit suppliers. Then we have the nominal ledger. For the nominal ledger, these are accounts that doesn't have a name of business or the name of person. So we use a nominal ledger for such accounts. So examples of what we use nominal ledger for are assets, liabilities, income, expenses, and equity. These accounts do not have names. That's why we open a nominal ledger for them. Then we go to introduction and history of double entry. Why did double entry come into existence? That is the point. So double entry came into existence because there's a business. So in as much as you have a business, you must, number one, record business transactions. So whatever transactions you do, you have to get them recorded. Two, show how much is owed and owned by the business. You have to record the amount you are owing to customers, which is the amount you are owing to suppliers, which is owed, and the amount customers are owing you, which is owned. The third one, show how much cash the business has. You must be able to show the amount of cash you have because the business needs liquidity. Liquidity is important for a business. That is the cash inflow and outflow. And the last one, show whether or not the business is making profits. So it is important because you have a business to show if you are making a profit or making a loss. So this is the end about the history of ledger. Thank you. So today we need to talk about rules of double entry. So the first rule about double entry, normally we already know what double entry is about for duality concept, which means for every debit there must be a corresponding credit entry. So what are the rules that we have to understand when it comes to double entry? Number one, double entry means all transactions have two postings. That means there's going to be the debit side and the credit side. So posting means you are transferring items after the transaction from the journal to the ledger. So we have to note that for every double entry system, we have the debit side and the credit side. Two, the order in which your items are placed doesn't matter. So whichever ways you post your double entry, it doesn't matter. I mean, in terms of the items, in terms of the accounts. You might post trade receivables first, you might post trade payables first, you might post individual account first. It doesn't matter in ledger or double entry. The third one, a debit entry is always assets and expenses. So when you're talking about the debit entry on your ledger, it should be the debit balance should be assets or expenses. For the credit balance or for the credit entry, it has to be income, liabilities, capital or equity. So on your credit side, you post on the credit side of the transaction, on your ledger you post liability, you post income and equity. For the debit side, it's always assets and expenses. So we have these accounts. So this will tell us how we have to increase or decrease each item of our transaction. That means we're talking about how we increase our assets, how we reduce our assets, how we increase our liability, how we reduce our liability, how we increase our capital, and how our capital or equity is being decreased or reduced. So, the first item here, we're talking about assets and accounting. So, assets are resources that the owners of the business, that belongs to the owners of the business. These are what we call assets. So, to increase your assets, what do you have to do? Increasing an asset meant that we have a debit entry. That means we are increasing our assets. So if you have to increase your assets, you have to what? Make a debit posting. Because whenever here we said assets are always on the debit entry. So if we have more assets, then we continue to post it your asset, it has to be a debit balance. Then, what happens when we have to decrease our assets? We can decrease our assets maybe because we have to pay customers, or we have to pay suppliers. So if we are paying suppliers, our assets of cash or bank would reduce. That means we have a credit. So to increase our assets, that means we are having more assets, it's going to be a debit balance. To reduce our assets, which means we are decreasing our assets, it has to be a credit balance or credit entry. Then for liabilities, what are liabilities? We're talking about things, resources that belong to third party, but the business is using them, or the business is using them. These are things we owe to third person, So to increase our liability, it has to be credit. So let's say we write debit and credit here. We write debit. Here we have credit. So to increase our liability, what do we have to do? We credit. Remember we said credit, liability, income, or equity, which is the same as capital. So to increase our liability, that should be a credit entry. To reduce our liability, that means we are reducing our trade payables, or we are paying our loans. It has to be what? A debit entry. Then the last one is capital or equity. Note, capital is the amount of money the owner of the business has put into the business. That is capital. The amount of money the owner of the business has put into the business. That is capital. Or the money that belongs to the owner of the business. That's capital. So to increase your capital, it has to be a credit entry. Then to reduce your capital, it has to be a debit entry. Why is capital, when we have to reduce our capital, why is it a debit? It is a debit because it means that we are making drawings. And drawings is always what? A debit entry. What are drawings? Drawings are the amount of money that the owner, the amount of goods, or the value of goods, the owner of the business takes away from the business. Remember, there's an accounting concept called business entity. Business entity. Due to business entity, that is why we have capital or drawings. So the business should be treated separately from the owner of the business. As a result, whenever the owner of the business puts money into the business, it will be recorded as capital, which is a credit. And whenever the owner of the business takes money from the business, it should be recorded as drawings, which is a debit entry. So this is how we post. This is how we increase our assets or our liabilities or equity. So to increase your assets, we make a debit. To reduce your assets, we make a credit. To increase your liability, you make a credit. To reduce your liability, you make a debit. To increase your capital, you make a credit.